Alright, so welcome to part 2 of Healthcare Stocks Value Trap Opportunity. If you have not watched part 1, pause this video and go watch part 1 where I talk about what are the issues that UnitedHealth is facing and why I'm not too concerned about the DOJ investigation, as well as what are their projections for growth in the future. And of course, in this video, I'm going to focus more on how to calculate the intrinsic value of UnitedHealth, as well as I'm going to look at Novo Nordisk. Is that an opportunity or a value trap? So the next question you're going to ask would be, so what is the business actually worth? Remember that in the short term, the stock price doesn't always reflect the actual value of the business, because in the short term, the market price is driven by emotions and by manipulation. Okay? Whereas the actual value of the business is called the intrinsic value. And the intrinsic value of a business is based on how much money it can make for the next, say, 20 years, discounted to present value. So usually for health insurance companies and for financial companies, we want to project the net income for the next 20 years and we discount it to present value. All right. And the easiest way to do that and to calculate the intrinsic value is using Stock Oracle. So if you go to Stock Oracle, you can see everything is done automatically for you. If you click on intrinsic value over here, you can see that there are many ways to value a company using mean price to sales ratio, mean price sales to growth, PE ratio, so on and so forth. So for UnitedHealth, being a finance company, insurance company, the best way to value it is using the discounted net income model. All right. So based on that model, you can see that the shares are worth $330 per share. That's the intrinsic value. Now, how does this come about? This is based on analyst projections. So if you scroll down over here, let me just show you. You can go to the calculator itself and see the inputs that are being used. So if I go to discounted net income model, there we are. So this is the net income of UnitedHealth for the last 12 months, which is $21 billion. They have got $79 billion in debt. They have got $32 billion in cash. We're using a 5.37% discount rate because it's a fairly low beta company. They've got 910 million shares outstanding. Now, where we can vary the projections is here. Growth rate year 1 to 5, growth rate year 6 to 10, and growth rate year 11 to 20. So by default, Stock Oracle is projecting that for the next 5 years, their profits will grow at 2.41%. This is taking into account the big 30% drop this year. And then it is further projecting that in year 6 to year 10, UnitedHealth will grow at 4% only. And then the last 10 years, it only grows at 4%. Now you may say, where does these figures come from? It comes from FactSet. Now, remember that Stock Oracle pulls the data from FactSet analysts, where these analysts will make all these projections. Personally, I think they're too pessimistic. Okay, because again, remember, historically, UnitedHealth has grown at 10 point, where was that? Historically, they've grown at 10.47%. Can you see that? And the management themselves have guided that you'll be growing at 13 to 16% from 2028 onwards. And UnitedHealth historically has always been sandbagging. I think it's called sandbagging, where they lower expectations so they can beat expectations. So if you ask me, my own personal opinion is that they should be able to grow at least 10 to 16%. Okay, so I am going to adjust the growth from 4% to 10.47%. Oops, hold on. Yeah, 10.47%. Right? So if I recalculate based on this, and that's the beauty of Stock Oracle, which is if you don't agree with the analyst projections that are pulled from FactSet, you can put in your own inputs based on your own understanding of the business. So if you put that in and you recalculate, you can see that gives us an intrinsic value of $412. And at the current share price of $237, which closed on Friday, it is selling at a 42% discount. So does this give me a big margin of safety? Yeah. Now again, what if I'm wrong? What if the company can't grow at 10% anymore? That they can only grow at 4%, which is what the analysts are very, very pessimistic about. Then even if you do that, hey, it's still worth $330. And at the share price of $237, it's still 20%. So even in the worst case scenario, I'm still getting a good deal. Now I may say, what if they can only grow at 2%, which is a bit ridiculous, but let's say, right, if they can only grow at 2%, then they are still worth $312. Now, if they could reach the midterm of their long-term projections between 13 to 16% projection, let's take a mid-range of, let's say, a 14.5%. Let's take a mid-range somewhere around there. And we punch that in over here to 14.5%. Then what are the shares worth? Then the shares would be worth $473. So if I go to the charts right here, you can see that, okay, best case scenario, if they can meet the midpoint of their projections, they're worth 473, which is somewhere about there, right? So is it 473? Yep, that's right, 473. That is so-called the, if they meet their projections. This is what I think is more conservative at only a 10% long-term growth, which is what they've done historically. And this is kind of like the worst case scenario if they are really screwed, all right? So the fact is that if the share price is selling at 237, which is way below the really screwed level, then it's a bit hard to lose money on this investment. So does this mean that the share price has bottomed and the share price is going to go all the way back up to here or somewhere up to here tomorrow or next week? Of course not. Remember that a great business will always go back to its intrinsic value over time. But I can't predict, no one can predict when it's going to happen. It may happen next week, next month, it may happen 3 years from now or 5 years from now. And that's why when people ask me, Adam, should I buy this stock? My answer to them is no. Even though I just bought more of the shares at $240 on Friday, I do not recommend that anyone else buy these shares. Why? Because I don't know your personal situation. I don't know whether you are in it for the short term or if you're in it for the long run. If you're a short-term trader, then you shouldn't buy the stock because it could go a lot lower, right? Because it's on a downtrend. But if you are someone like me with a long-term perspective, you're holding it for the next 3, 5, 10 years, and it's also paying a very nice dividend, then if it's me, I'll buy it, right? So it really depends. Are you a trader or are you an investor? A trader should never buy this because it could still go a lot lower. But as an investor who's willing to hold for the long run, who's willing to average down more, who's willing to collect the dividend, then yes. So it all depends on you. That's why never take advice from anyone, including me, because we are all in different financial situations. We've got different financial objectives. Now, if we take a look at the technicals of the charts a bit closer, I can give you a bit more perspective, right? So let me kind of like zoom out a bit over here. So you can see that it just made this low and it just breached this low. So a few things can happen. So if the price is able to close back above 248, then this could form what we call a bear trap and it could reverse back up from here. But if it continues to break below 248, then could it go to the next support level of 187? Of course it's possible, right? So we never know where a stock will bottom, but it will eventually bottom at usually one of the previous swing lows or support levels. So it could reverse from here, it could reverse from here, who the hell knows, right? And that's why we always need patience as an investor and not expect it to jump up immediately because no one can do that, right? Now, another interesting chart I can show you is the long-term chart of UnitedHealth. If you look at a long-term chart, you can see that, again, it has dropped 62% this time. Has that happened before? Yes. You can see historically it's dropped 56% here, it dropped 60% here as well, it dropped 76% here. And of course, these were smaller corrections. So this is nothing new. This company has gone through much bigger drops and has gone back to all-time highs many, many times. Now, another healthcare stock that has taken a huge beating, the stock price is down 68% from the high, is Novo Nordisk. And this is another fallen angel. So Novo Nordisk is a market leader in obesity and diabetes drugs. In the obesity market, they've got 70% market share with brand names like Wegovy. And then in the diabetes market, they've got like about 33% market share with brand names like Ozempic, which has been made popular by a lot of celebrities. So recently the share price dropped. Why? Well, there are two reasons. The first reason has been this narrative from the Trump administration. They want to cut drug prices and the tariffs, and so that is creating pressure on the stock. The other main reason is because they have been lowering their growth forecast, and that's the main thing that has driven the stock price down significantly. So again, is this an overreaction? And is the share price very undervalued at these levels? And is it worth something to invest in for the long run? Well, let's check it out. So again, question, is this a broken stock or a broken business? And again, you have to look at the financials. Is it a broken business? Are they losing money? Are they going to hell? Okay, or are they still making money? Well, let's go to Stock Oracle and take a look. So on Stock Oracle, well, the first thing you can see is with Oracle IQ, gives you a great overview in terms of predictability is ranked very high, profitability ranked very high, growth has moderated. It used to be very high, it's now come down. In terms of their economic moat, their competitive advantage is still ranked very high, financial strength medium, and valuation ranked very high, which means they appear to be very undervalued. Now, if we take a look at the financials, and we can see, again, are they a company that's still making money? Are they making good money? Let's go to the bar chart. So sales revenue, as you can see, is still growing very, very nicely. So not an issue, all right? And you can see net income in green growing as well as free cash flow on the right in dark green is still growing as well. So the business is not broken. It's still making money, it's still growing. How about the economic moat? So let's click on the AI moat analysis. And you can see that it has got a wide economic moat. In fact, it's got a score of 9 out of 10. It's got brand loyalty and pricing power. It's got high barriers to entry, high switching costs, no network effect, and it's got very high economies of scale. So what's the problem? Okay, so the main problem is that this company has been growing at huge double digits, but then recently they have forecast that their growth is going to slow to low double digits, and the market panicked and the share price is down like 68%. Now, to be specific, let's take a look at what were some of the recent comments made by management that freaked out investors. So they cut their full year sales forecast, which was initially 13 to 21% sales forecast. They've now said, oh, we can only grow at 8 to 14%. And the market panicked, right? And their profit growth that was 16 to 24%, they've now cut it to a profit growth of only 10 to 16%. And they fired their CEO for not doing a good job, and they put in a new CEO. So all this uncertainty has caused the stock price to be broken, at least temporarily, right? So what do I think? Now, first of all, let me tell you what I don't like, okay? So what I don't like is that the company has been blaming the competition. They said because of Eli Lilly, the main competitor, as well as copycat compounding drug companies making copycat drugs, that has reduced their growth because of competition. Now, that's not something I like to hear. Why? Because if a company is showing slowing growth because of competition, that tells me that their economic moat, their competitive advantage is not as strong as it once was. So that's something that I don't really like. Second thing is that the management is so-called blaming their competitors, which I don't like. I don't like competitors to blame anyone, right? They need to take responsibility. So that's something I don't like. Now, having said that, I do have a small stake in Novo Nordisk, and on Friday, I did buy more shares. I may say, but Adam, if you don't like what they said, why are you buying more shares? Well, the reason is because I think the share price has dropped to a ridiculous level where it doesn't make sense. And even if they continue to lose market share and their growth slows even more, it's a bit hard to lose money at the current share price because it's so undervalued, right? Now, again, having said that, it doesn't mean that the price has bottomed. It can, of course, go a lot lower because in the short term, it is all manipulated. It's all driven by emotions. But if I have, again, as an investor, I've got a longer term time horizon, it's a bit hard to lose money. In fact, I think it's an easy double for me buying the shares in the next couple of years. All right, and let me explain why. So first and foremost, the good thing is that, well, is it good or bad? Okay, good for the business, bad for society, right? So the good thing for the business is that the number of people with diabetes is increasing, which is bad for the population, obviously. You can see that in 2024, there were 551 million people with diabetes, and they are projecting that in 2050, which is 25 years from now, there'll be 810 people with 810 million people with diabetes. So that's a 47% increase in the next 25 years. So more and more people are getting diabetes because of lifestyle factors, right? So here's the point. Even if Novo Nordisk continues to lose market share, but because the industry is growing so much, there are more and more people getting diabetes, they can still grow their revenue and their profits double digit even if they lose market share. Okay, so that's my point. Now the second point is, so what are the shares worth right now? So once again, remember, what is the intrinsic value of a business? A business, what is it worth? Is based on how much money it can make in the next 20 years, and you discount that to present value. So we're going to use a free cash flow valuation method, and the easiest thing to do is again go on to Stock Oracle to do a quick calculation. So on Stock Oracle, I'm going to click on intrinsic value over there, and you can see there are many ways you can value a stock: PE ratio, price to book ratio, price to sales ratio. But I think the most appropriate method is the discounted free cash flow method, which you can see the algorithm give you a valuation of $89. That is the intrinsic value. Okay, and at the current share price of $48, it's like almost half price, right? Almost half price. Now, how is this derived? Now we can take a look at the actual calculator over here. Let me change this to discounted free cash flow. Okay. So in the last 12 months, the business generated 13 billion in free cash flow, total debt 17 billion, cash and investment 6 billion. We're using a 5.37% discount rate because it is a low beta stock, given it's in defensive healthcare. The growth rate projection used by Stock Oracle, that is pulled from FactSet analysts, for the next 5 years, they're projecting a growth of 14.47%. Now, is that fair? Well, recall management has said that they expect profit growth to be between 10 to 16%. That's the management guidance, right? So 14% is pretty fair, okay? And then in the next 5 years, years 6 to 10, FactSet analysts are projecting that their growth will halve from 14% to 7.7%. And for the last 10 years, it will just grow at 4%, which is pretty conservative, right? So based on this calculation, you can see that the intrinsic value derived is $89.53. And at the current share price of $48, it is 46% undervalued, okay? Now, personally for me, I would take this valuation because I like to be conservative, okay? But if you believe that, hey, the whole diabetes and obesity industry is growing, okay, then it should continue to grow at more than 7.7%. So if you put in, say, 10%, then shares will be worth $96. So it depends on how optimistic you want to be, okay? So if we go to the charts, we can put in $96 as the so-called the more optimistic valuation. $89 is the more conservative valuation. Now, how about we have a doomsday valuation? Like, what's the worst that can happen? And you can see that even if I put in a growth of half what they're projecting. So management is projecting what? They're projecting 10 to 16%, right? So let's say we take the lowest, which is 10%, which is the worst, okay? So we put in 10% here, and then we assume they're gonna lose half of it, okay, in the next 5 years, and we recalculate it, in the worst case scenario, the shares are worth $68, which means at the current share price of $48 is still almost 30% undervalued in the worst freaking case scenario. And this is what we call a margin of safety. So let's put in $68 as so-called the worst case over here, $68 somewhere over there, right? So again, at the current share price of $48, it's, to me, it's ridiculous. That's why I couldn't help myself on Friday. I said, fuck it, I'm buying more shares. It could drop lower, I don't care, right? Because I know it's worth this amount. And I know that over time, it's going to go back there. Maybe not tomorrow, maybe not next week, but over time, it's going to go back there, right? So again, should you buy this stock? The answer is no. unless you are someone who's investing for the long run. If you're someone who's in it for quick money, you want to get in, get out, then maybe not, right? Because again, it could go lower. It's on a downtrend. But having said that, this is a pretty strong swing low pattern, and it could be making a double bottom bear trap. So if we see a bear trap formation with a bullish reversal candle, then this could be the bottom. You never know until that formation forms, right? So I do hope I've given you some, perspective about how I look at companies, how I invest. And again, this is not a recommendation for you to buy UnitedHealth or Novo Nordisk, but it's for you to understand the principles of how we make smart investment decisions, how we look at risk versus reward, how we look at, is it a broken stock, broken company? And remember, if it's a broken stock, but not a broken company, okay, 99.9% of the time, the share price will always rebound back to and above the intrinsic value. And that's how we make money, by looking for these mispricings in the market. So thank you for listening. If you have questions and comments, leave them in the comment section. And thank you. I'll see you guys in the next video. Till then, may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.